Is Pfizer one of the most undervalued companies in the stock market right now? It is down nearly 25% over the last 12 months, trading right there towards its 52-week lows with a double buy rating and in fact a yield that is near enough 6%. And to top it all off, over the last month, this is up nearly 12%. So is this one we need to consider for not just a very nice strong yield, but also in terms of future massive growth? As always, we are going to take an in-depth look of this company. We also want to look at their dividend safety, very important with their yield nearly at 6%. Also some of the supporting underlying metrics, free cash flows, as well as that. We'll also have a quick refresh on how they performed in their earnings just a few weeks ago, as well as some new news about how they're looking to reduce a lot of costs, which will really help with their balance sheet and the total debt that they do have, which is fairly large. And as always, we'll run through a few very important slides from that latest investor presentation, like their forward guidance as well, to understand where the growth is coming from. And we'll look towards both insiders to see whether they've bought or sold any over the more recent quarters, as well as the institutions to understand whether or not this is one that the big companies and corporations have been adding to their portfolio overall. It's also be important for us just to understand how they've performed, not just pre-COVID, but also after, whether there has been any growth, both on a top line as well as bottom line basis, and understand the health of this company, their total cash versus their total debt. They have done a lot of acquisitions as well, whether or not we can see that reflected in this company overall. And as always, we will run them through the valuation model, getting to our own intrinsic value, our acceptable buy price given our investor margin of safety, and look towards Wall Street to see what they're forecasting in terms of growth over the next 12 months. Now, just as a reminder in terms of how they performed in their earnings at the beginning of May, what we can see on the top line, they did beat their earnings estimates as well as raising their outlook, which is very strong from any company when they do have a double beat. And what we can in fact see here when we do take a look at some of their numbers, just so you can see how strongly they performed, they came in earnings per share 82 cents with 52 the anticipated by the market analysts. And in fact, on their top line revenue, they also beat 14.88 billion versus 14.01 again expected. In terms of their net income, their bottom line, what we can also see, it came in around 3.12 billion. However, when we do compare that to the same quarter from last year, it is slightly lower at 5.54 billion. So lots to unravel in today's episode. As a reminder, they have rebounded nicely over the last 30 days, up 12%. Year to date, pretty much flat. But if you've been a shareholder over the last year, you would be down negative 25%. And if this has been a long-term investment, well, you would have been on a massive roller coaster, up around 3%. But we do see all-time highs sitting around the $60 mark. Right now, though, the share price is pretty much half of that value. In terms of the forward P, we do also see it trade around 12.23. Now, the S&P is around 22 currently on a forward basis, but what's important for us is to understand how others in the market and the sector in particular are trading to get a real sense of the comparison. Now, just to let you know, in terms of insider ownership, it does sit very low, 0.06%. We do in fact see one insider who has bought over the last 12 months for just under 80,000, with no insiders selling over the last 12 months. If you want to see that insider buy, though, you have to go back to around Q4 of 2023. And in terms of who that insider was, we can in fact see it was the director, as you can see, 15th of December, 3,000 shares for a share price $26.47, so marginally lower than the current value. Whether or not you believe, one, that is a bullish signal, or two, that is outdated, the information is there. One thing that we don't really comment on are the US Congress members, but again, for transparency, you can see their buys and sells. In terms of looking at the institutional aspect, well, 68%, and what we can see here is 12.53 billion worth of sales by these institutions over the last 12 months. A lot more buying, in fact, 82 billion buys over the year period, so a lot more buying. But what we want to draw your attention to is in the more recent quarter, Q1 of 2024, we do notice a lot more selling by the institutions than buys. So just to wrap this up, this part, what we can see is insiders have been buying, although it was just one insider, for a fairly trivial amount. And in terms of institutions, yes, they've been buying more over the last 12 months. But in the more recent quarter, Q1, we do see the opposite. As always, though, do your own due diligence, never copy what these insiders or institutions do. Now, in terms of total revenue, this is essentially analysis for those that maybe are more newer to the company. They reported 59 billion in December 2014, Bear in mind we want to see 3 to 7% growth as a minimum baseline. They then reported in their more recent annual accounts 58 billion. We want to show the inconsistency, and in fact up until COVID, as we can see 2020, their top line was decreasing over the longer term. We see that jump up until 2022, but from then we do note it has come down, and what we can in fact see over here is the increase around 81 billion in 2021, 100 billion in 2022, and then that massive post-COVID drop down to 58 billion. Now, the one thing that we would point out is throughout this time, and we will take a look at their cash, we can also see that massive jump from COVID going from 42 billion to 82, then 100 before dropping. And essentially, when we look at their balance sheet, we will see a lot of cash that they did have at that time. And what they have been doing in terms of this are looking at a lot of acquisitions. In fact, not too long ago, they did spend around 43 billion on CGen, and essentially this was looking to further their oncology products and services. So that is one area that we do expect their top line to increase over the longer term, as we can see that massive COVID drop. And then when we take a look at their bottom line net income, we can see again very inconsistent, 9.1 billion in 2014, 2 billion in 2023, and we can see on a graphical basis what we truly mean about the inconsistency from that COVID increase. 21-22 down sharply into 2023. Now, in terms of the health of this company, their total cash and short-term investments versus total debt, 36 billion in 2014, 11.9 billion in their latest quarterly report. So we can see their cash over the longer term has in fact been decreasing. We see that massive increase into 2021, and as we said, from that point they have been doing a lot of acquisitions to help increase their top line, as COVID isn't something they're going to continue be able to sell their products for the foreseeable future. And then we compare this to their total debt numerically and directionally, and what we can see, it has been increasing rapidly, 37 billion in 2014, and as we can see their latest annual report as well as their latest quarterly report, 70 billion. So we can in fact see their total debt over the longer term has been increasing, and we'll take a look at their investor presentation where they do talk about paying down a lot of this debt over the future quarters so they can reduce this issue that they have with the ever increasing debt level. Now we take a look at their earnings data, always a very good sign to see when companies and their track records, and what we can see for Pfizer over the last 4 quarters, they have beaten quite considerably as well, we would say, so a 100% track record. Forwards looking, well, in the next quarter, they're anticipating the earnings per share to be a year-on-year decrease of 32%. And we can see in quarter 4 a very large increase, quarter 1 a decrease double digits. So pretty inconsistent, but at least we can see the more recent quarter that we're anticipating it to be a drop from the same quarter last year. In terms of the data moving forwards, well, if they do hit their earnings per share estimate for December 2025, their forward P will sit around 10.49, just something to consider as part of your own investment thesis. So the first thing we want to look at is their valuation grade and the underlying support. A-, and on a P non-GAAP basis, one of the first metrics we look at, 12.23. Others in the sector are trading at just under 20, so you are essentially getting a 38% discount on Pfizer in relation to others in the similar sector and size. There are other valuation methods if you want to look at. One that we also take a look at is a price to cash flow basis, 9.81. Again, you are getting a discount to the sector of around 36%. Whether or not you do believe that Pfizer is a strong company sitting in the sector, that is for you to decide in your own due diligence. But as we can see, overall, an A- on the valuation. We then take a look at their growth grade, and what we can see, a D+. It does make sense when you look at the data. Negative 41% growth year on year. Sector does signal growth around 7.02%. On a forward-looking basis, they are also anticipating a decrease to their top line. Sector just under 9%. And one other thing that we draw your attention to is the expectation of the earnings per share, just over 10% year on year over the next 5 years, with others in the sector marginally higher, 11.19%. Again, other metrics are here if you do want to use them in your own investment analysis. We then take a look at the profitability grade. They get an A+, as we can see here. Gross profit margin, 59.41%, so marginally higher than the sector. Bottom line though, we do notice on a trailing 12-month basis, negative 0.56%. Yes, not great, but when you do look at the sector as a whole with a negative 4%, it is sitting marginally better. Again, other metrics that you can take a a look at. Cash from operations, very strong, 8.6 billion, with others, in fact, a negative 16.6. So a wrap up for this part of the analysis, a double buy rating, a hold from quant. We see an A- on the valuation, a D+ on the growth, with an A+ on profitability. Now, one thing that we always like to look at is the performance against others in the sector. Now, for this pharmaceutical analysis, we have Roche Holdings, GSK, AstraZeneca, BMY, as well as Merck & Co. And what we notice on a total return, so that is reinvesting the dividend as well, which currently sits at near 6%. Pfizer is one of the worst performing. In fact, half of these companies have returned negative over the last 12 months. On a 5-year basis, we see Pfizer actually the worst performing, down 11%. Over the last 10 years, though, they are in the top 3, up 51%. Nonetheless, that is a pretty terrible return on any investment over that period. But as always, remember that past performance doesn't mean that they're going to follow this trend over the next 10 years. Just something to think about and maybe incorporate it into your own investment thesis and margin of safety. Now, the other thing that we want to talk about, something very new, in fact, from last week, they are looking to save around 1.5 billion costs in 2027. And as we can see, they have effectively launched a new multi-year program, reducing their costs. The main reason for this, as we can see, their business since COVID has declined on both a top-line revenue basis as well as a bottom-line net income basis. And this is in addition to the 4 billion cost-cutting effort which they have already got in line. And we can take a look at that as part of their investor presentation. And they're hoping ultimately by 2027 that an additional 1.5 billion will be saved. So something just to consider. Now, we also want to point out that we have released our latest free weekly article. We talk about the best recession-proof stocks to add in your portfolio. We have other articles all completely free. You can click on the pinned comment below, instant access. For example, 20 undervalued dividend stocks to consider, or how to find undervalued stocks, all the websites that we use, so you can also take a look. Now, before we jump into the dividend safety of Pfizer, we want to run through their investor presentation. Just a few things to point out that maybe you would have missed if you had taken a look. First one is essentially that they are looking at new products for this company, and what this effectively talks about is their phase 3 study. Now, if you have watched our other videos on pharmaceuticals, you will know there is a phase 1, a phase 2, and a phase 3 before the registration. This isn't too far then from essentially becoming into the mainstream. So they do talk about a few strong products in the oncology area that will hopefully help the people in this world. Now, they also talk about key potential growth drivers. Again, more different products that they are hoping will propel their top line to really help from that massive drop that we did see from COVID. Now, in terms of how they allocate their cash, well, just in Q1 of 2024, they talk about 2.4 billion in terms of returning that to shareholders through the dividend, as we said, around that 6% level. And they are looking to not just maintain, but also to grow their dividend moving forwards. They paid 1.3 billion in debt, always great, and in fact they talk about another 1 billion debt repayment scheduled for May 2024, so hopefully they have made that payment. Always great, that does help both the balance sheet strength as well as dividend safety. And they talk about here we're investing 2.5 billion into internal R&D, that's research and development. But one thing that we just want to point out, maybe you would have missed it, but they aren't planning in 2024 to do any share repurchases. Now, in terms of their guidance, something just to note, we did touch upon it when we looked at their earnings, but they have increased their guidance. Earnings per share now 215 to around 235. As we can see, prior to that, they were anticipating 205 to 225, and we can see their revenue 58.5 billion to 61.5. If you want to compare this to what they reported last year, we can in fact see it was around 58.5. So as a bare minimum, they are looking to be flat from the prior year, but ideally they do want to hit that 61.5 billion. So always good to look at companies, their forward guidance, to see how they're performing against past performance. Now, in terms of dividend safety, well, a score of 75, it does look to be safe. Market cap 162 billion. It is a mega cap company, and it was just reaffirmed a couple of weeks ago that their dividend is safe, and a dividend cut does look to be unlikely. Now, in terms of the key metrics from the last recession, they did in fact cut the dividend. They didn't even maintain it. That was the 07-09 Great Recession. Recession sales, negative 6%, above the average. Remember, that was negative 12 for the S&P. And they also marginally outperformed the S&P, negative 45 versus the S&P's negative 55. This increase was 2.4% in December. Not the greatest, as we always say, get a minimum of 4% just to keep up in line with inflation. At a minimum, we see that over the last 5 years, and marginally higher over the last 20, sitting at 5%. Now, they have been increasing those dividends for the last 13 years as well. And when we do take a look at dividend yield theory, For those that are new to the channel, it states the company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. We also note the forward P pretty much in line with the 5-year rolling, but what we can say is it is much lower than the healthcare sector of 16.2. Do bear in mind we're not looking at any one of these models in isolation, and we will conclude shortly. Now we do focus on the free cash flow payout. Remember, earnings is susceptible to manipulation by management through accounting. Below 60% is what I target, and with free cash flow you can always identify any companies that have any dividend cuts that are upcoming. What we noticed, 2023, 193%. If you were to look at the earnings, you would be none the wiser, because what we can decipher from this is that in 2023, management paid out more in dividends than they generated in free cash flow, a red flag indicator. 2024 anticipated to come down to 86%, still a little bit too high, so don't expect any massive increases from Pfizer in the shorter term. Free cash flow per share, well, we do want to see increasing free cash flows year on year. We do notice from 2014 to 2020, pre-COVID, it has been fairly stable. Then they had a very large increase the following 2 years, and then a massive drop, but they are anticipating an increase into 2024. Always good just to have realistic expectations with the companies you are analyzing to understand the business and realistically how much they can increase over the longer term. Now, sales growth, we did look at this, but this is the percentage format. We noticed a massive drop in 2023 of 42% with the new products they are hoping to bring out, as well as the acquisitions of CGen. Hopefully this will start to increase over the next few years, and we can see their total sales numerically over the longer term, something that we analyzed earlier. Now, we do love it when companies do share buybacks, returning excess cash. We can see that over the longer term. Just to point out, though, as we talked about in that latest investor presentation slide, they aren't anticipating any share repurchases in 2024. Now, ROIC, return on invested capital, what we ideally look for here is 10% or more. Gives us faith management are able to effectively allocate their capital. And what we can see over the longer term, very inconsistent, 3% over the last year, 2% over the last 12 months. Just something to factor in and understand, because our target realistically is around 10%. In terms of the operating margin, well, then what we can see, 12% or more, but it has been dropping over the longer term, 9% in 2023, 6% on a trailing 12-month basis. Definitely something to keep an eye on. The lower this goes, the more likely is the company will return a net loss instead of a net profit. Same to be said on the free cash flow margin, although whilst 5% is our minimum, it has dropped massively from 2022 down to 8%. Nice to note there is some increase on a trailing 12-month basis to around 9%. Now, the net debt to EBITDA, the earnings before the interest, tax, depreciation, and amortization, this essentially shows us the number of years it would take the company to pay off all of that debt net of cash on hand. And remember, this correlates to both dividend safety and balance sheet strength. Below 3 is what we want to see. It has gone much higher, a massive jump to 3.75 in 2023. So that is again a red flag indicator. The positive to take is that it is expected to drop very nicely down to 2.58, so below our threshold into 2024. But as always, something that we would say just to keep an eye on, as this does correlate to the dividend safety. So if this does go much higher over the longer term, then we will in fact see a potential dividend cut. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model that we're looking at is Graham's valuation. We have the earnings per share with the stock ticker symbol, the long-term growth rate per analyst targets, and the AAA corporate bond yield, giving us an intrinsic value of $33. So we do have our first undervaluation signal. Just bear in mind, we're not looking at any of these models in isolation. We then move on to the multiples valuation model, where we have the companies from a similar sector and size, their P multiple, the average, multiplied by the EPS of Pfizer to give us another intrinsic value where we do see some massive undervaluation. We then take you on to the dividend discount model, the growth rate over the last few years coming at 3.14%. We've gone a bit more conservative at 3%, which does give us an intrinsic value of just over $34, and we can see a third undervaluation signal. We then move on to the DCF model, free cash flow year on year, average at 3.5%. Forward looking, we've gone for 6%. We do believe this to be in line with analysts. With their discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get to another fourth, in fact, and final undervaluation signal. So the intrinsic value in today's episode is just the average of these four models, and it does get to $36. Remember, you can click on the pinned comment below, grab a copy of this valuation model to get to both intrinsic and acceptable buy price of companies in in your own portfolio as well as those on your watch list. Now remember, we do execute on stocks at a 10% margin of safety if they meet our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that for Pfizer we'll buy up to $33, then we keep going till it's near the current trading price, and in today's episode it is around a 20% MOS level. At 25%, you'd have to wait for around $27. So in today's episode, around a 20 to 25% based on the estimates and judgments we just ran through. In terms of Wall Street, well, they believe the share price will go up to around $34.20 over the next 12 months, with upside of 19%. As we saw, they do consider this a buy alongside seeking alpha analysts. As always though, let us know your thoughts in the comments below. Is a 20% margin of safety enough for a company like Pfizer with a yield nearly at 6% and potential upside of 19%? Or maybe this is one that in fact you need a larger margin of safety and you were buying it maybe before the 10% run up just over the last 30 days. As always, if you enjoyed the content, value was provided, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and as always, we'll see you all on the next one.